we'll go ahead and call to order. This meeting is being recorded. I'm Representative Lou Jones. I am the chair of this subcommittee. We are going to take a look today at some of our, as we try to narrow in our focus on our Homestead and Comstead potential settings that allow us to potentially be able to address some of the owner dwelling and some of the long-term rental rates, along with some of the smaller business rates. We also are going to try to take a look at the overlap, because as you adjust the Homestead and Comstead exemptions, you're also going to impact some of our what I call circuit breaker programs, the PTAP and disabled veterans and the land valuation programs that are currently providing some relief. And so ultimately, as we analyze doing the one, we're going to have to analyze the other and see what integrations may be needed, what adjustments, so that our help in one area doesn't become a hindrance in another area. And I guess a lot of these other remarks we can discuss as we go through the system. Again, we're looking primarily at this point at property tax, which all goes local in the end. 95 mills returns to the schools. Ultimately, the 6 mills, I guess the 6 mills are state mills, but they go to the university system, which is spread all over the state. Places like Northern up here in Havre or Bozeman, Missoula, a bunch of the units around the state. Again, I always say this, so I might as well say it anyway. The income tax, the state primarily runs on income tax. Although if you look at state funding, 93% of the general fund, if I remember my last glance at the pie, also returns local, primarily to 3 big areas: public safety, right? Incarceration, prisons, public safety, those areas. Medication, the DPHHS series, which is often your nursing homes, hospitals, and your support there. And of course, education, which is a combination, primarily K-12, but certainly K-12 and higher ed. And so with that as a background, we're slightly late on our 905 item, but we will begin there. I believe Dylan Cole and Eric, you are up on how does the distribution of the property value and income on PTAP.
Dylan, can you give me one moment? For the record, I'd like to note that I note on the participant list that all the members of the tax fairness subcommittees are in attendance.
Oh, I apologize for not having you take roll. I am sorry.
That I think that's fine. It's Representative Jones, Mr. O'Hare, Senator Fern. Wait, I might have promoted him. Apologize. Dr. Hopendale, Ms. Johnson, Commissioner Okers, and Ms. Wiggers are all on. I have them listed as in attendance. That's it. Dylan, thank you.
All right. Hi, everybody. Dylan Cole with Tax Policy and Research at the Montana Department of Revenue. Ralph asked me to put together kind of a high-level overview of PTAP and MDV, and we can look at some characteristics of these programs and then talk about how the Homestead exemption might interact with them. So this is the table of income limits for these programs.
Can everyone see Dylan's slideshow?
I can.
Okay. It's just, there it is. I can see it too now. Sorry, it's hidden behind the screen.
Okay. So a table of the exemptions, the percentages for PTAP, you can have, so these percentages are how much of your market value you're paying taxes on. And for PTAP, there is a limit of $350,000 for that amount. But so if you're married and your income is $18,310 or less, you only pay 20% of the value of your home up to the first $350,000. And it goes down that list, 50% up to 27,500, and then you're paying 70% up to 37. And any value you have above 350,000, you're paying the normal market rate on. And that 350,000 was just bumped up from 200,000 in this current tax year, TY 2024. Montana disabled veterans, on the other hand, is a little more generous. You can make up to 55,000 basically and pay no taxes on your house. And then there are 20, 30, and 50% multipliers on incomes up to about 70,000. So Montana disabled veterans is more generous, but that's the prerogative of the legislature. And I know the Constitution of Montana specifically says it's, veterans it's fine to give them more generous programs and beneficial treatment. It's obviously harder to get into Montana Disabled Veterans Program than it is to PTAP because you have to be a disabled veteran. Dr. Horpendahl, go ahead.
For the Disabled Veterans Program, is there also a $350,000 limit or anything like that, or is that just for PTAP?
Good question. That's just for PTAP. There is no limit on the home value for Montana Disabled Veterans.
Okay, thank you.
Yep. All right. So, sorry, my dog is barking. Macy. All right. So I guess I got ahead of myself. So PTAP applies to the first $350,000 home value. You can't be enrolled in both PTAP and Montana Disabled Veterans. It's kind of a moot point because if you qualify for disabled veterans, it's a much more generous program, so you would always choose that option. And then we also have the Intangible Land Value Program. So to give you a sense of scale, there's about 20,000 homes in Montana enrolled in PTAP, about 3,000 in Montana Disabled Veterans, and there's 200 properties taking advantage of the Intangible Land Value Program. What this program does is it exempts land value that's in excess of 150% of the improvement. So in this example, if you had a $200,000 home on a $500,000 piece of land, your total property value is $700,000, but you could exempt any land value that's in excess of 300,000, which was 200,000 times 1.5. So this property would receive a $200,000 exemption on their land. To take advantage of this program, you have to have had the property in family ownership for 30 years. So again, it's a much higher bar of, it's a high bar of ownership requirement, and it also has to be your primary home. But there is no income test on this program.
So this came about, just so folks understand what was going on. We had folks coming in saying, look, we've lived in a fairly modest home often on a piece of property, and the world built up around us. We're seniors now. We've been here our whole life. We've owned this home for a long period of time. But now this has become the lake area, an incredibly popular area, and lots are selling for $1 million. And so we're getting taxed out of our $200,000 home because we can't afford the value of the lot. So it was for those folks that said we're long-time homeowners that have lived in this area and would like to continue out living in this area, but the lot value has become incredibly unreachable. This was an attempt to answer that challenge.
Right. And so this Intangible Land Value Program does not have an exclusionary aspect with disabled veterans or PTAP. And there were about a little more than a tenth of the properties in the Intangible Land Value Program are also enrolled in PTAP in 2023. So this is income distribution graph, histogram. Well, I guess this is a bar chart or a histogram. The bins at the bottom are $10,000 increments. So first off, there's non-filers. This is all data from the rebate. So non-filers means they didn't file an income tax return, presumably because their taxable income is less than the standard deduction, so they have no liability. There are also people, and so then the zero category is people from $0 to $9,999 10,000 is 10,000 to 19,900. So in the red, we have people that are enrolled in PTAP. As you can imagine, they're primarily concentrated amongst the lower end of the income spectrum. But there are a couple blips out in, 70, 80, 90,000. Why is that? They shouldn't qualify for PTAP. Well, the PTAP for tax year 2022 is based on income earned in 2020. So there are some examples of properties or homeowners whose income has increased since they qualified for PTAP, and they would fall out of the program, potentially back in if their income went down in the future. We've also got Montana disabled veterans and the intangible land value on here. It's pretty hard to see because there's so few people in these programs. So on this next one, I've normalized it based on the percentage of people that fall into this category. So I took the count divided by the total number in that group. Non-filers for our 3 property tax assistance programs goes off the chart here. I had to cut it off so that the rest of it was more readable. You can see still that PTAP declines incredibly fast in terms of percentage of people that are engaged in the program. By the time you hit 40,000, it's already quite minimal how many people are in. That makes sense because the income limit for PTAP is $37,000 at the top end. Montana disabled veterans declines much slower. Not much slower, but slower. And again, that's, pretty reasonable because that one caps out at 70,000. The intangible land value, there is evidence that there's a greater proportion of people taking advantage of this program in lower income levels, but you can see that there are also some very high income individuals that take advantage of this program as well. And then other homeowners kind of relatively normally distributed, and I would say, there's not like a bunching at the lower end. It's kind of in the middle at around $60,000, $70,000 in income. So what about the homes that these people own? Same color scheme. You can see that the primary homeowners are pretty normally distributed around $300,000 in market value as of tax year 2023. And then there's not that same norm. So the normal curve refers to like a bell-shaped curve in the counts. The red line doesn't have a bell-shaped curve. It's pretty flat actually from no market value up to about that $280,000, which is about the median home of our primary homeowner population. And then it starts to taper off from there. So there is evidence that people in property tax assistance program actually tend to own lower valued residences than the average homeowner in Montana. And then the other programs are hard to look at because, again, there's so few people enrolled in them. So same idea, take that as a percentage instead of a total. And again, this backs up what I was saying. There's a much higher percentage of people in property tax assistance at lower values. Montana disabled veterans too, I would say they tend to own slightly lower valued homes than the average homeowner. And then you can see the intangible land value has, it's super spiky because, one observation really bumps up the graph a lot. You can see that they tend to own more expensive properties, but that's expected because it is a program specifically meant to deal with extremely high value properties. All right, so there has been some talk that I've heard of if we adopt this homestead model, should property tax assistance be in either or with the homestead model? And so what I did here was modeled a homestead model where we move the normal rate up to 1.9%, and then a primary home would have a beneficial rate of 1.1%. And I've compared that, and so then I said, okay, let's say you're enrolled in PTAP. Would you ever pick the homestead exemption instead of PTAP? And you can, and in the red, I've marked where it's worse to take a PTAP than it is to take the homestead. So you can see that the 70% PTAP is completely invalidated. There is no reason to ever take the PTAP program at the 70% level because they're receiving a 40% reduction by engaging in the homestead model rather than 30% reduction PTAP. So I would argue that that's, the first red flag that maybe this isn't a reasonable thing to do without majorly overhauling the program, because you now have a means tested income limited program that is worse than an option that you're giving to all income levels. At the 50% level,
But this assumes they're an either or, right? You have to choose one
correct,
or the other,
correct, yep,
which is a decision we have to make, one or
right,
the other,
that's
not
true.
both.
This
Yeah,
is specifically looking at the instead of, rather
instead
than
of,
allowing them to
instead of
stack on each
allowing
other.
both.
Correct. So at the 50% level, it would become better to engage in the homestead exemption once your home got above this $350,000 level, because again, PTAP only applies to that first $350,000 of home equity or home value, not equity. And then at the 20% level, if you were in that level, it makes sense until you get to pretty high home values. But again, because of that $350,000 limit on the amount of exemption offered to PTAP, it does eventually become more beneficial to just engage in the homestead. And so then on the bottom right, I've got the tax rates that PTAP participants are currently paying. So 70% at the 70% level, receiving a 30% reduction on the current 1.35% rate means they're paying a tax rate of 0.9%. 50% is 0.7, and 20% is 0.3. So then I just went to the new, again, this is all assuming that they wouldn't stack on each other. The 70% would only bring you down to 1.3, for example, instead of the 1.1 of the homestead. So if you did allow them to stack on each other, I know just from some internal discussions, it makes things complicated in terms of tax bill reporting, because you're like, especially in the extreme case, if you had a high valued home, it would be possible to have homestead, PTAP, and above PTAP, but homestead, and then above homestead. And that could, and that could be on the land and the improvements. So there's potentially a lot of different categories of tax rate that can happen with that. But the flip side is that if there weren't overhauls to this program, it kind of breaks it, I guess, is the point. What about intangible land value? Should that be instead of the homestead? So this one, remember, you can take PTAP or MDV and still be enrolled in this intangible land value program. This one is, I guess, well, so I just got some stats, I guess, about what these homes look like. So you can see that on the low end, there are some, not many, but there is one home that's only got $110,000 value, and its land exempted is 4% or $4,000. And these columns might not be the same property. It might not be that this 1% belongs to this lowest market value home. It's just, this is the minimum percent exempted is 1%, but in some cases it's 91% of their value that's exempted. So the homestead exemption is going to hit these properties differently. For this 1% home, the homestead is going to be much more beneficial than this current intangible land value program. For this 91% home, the homestead exemption is not going to come close to providing the same level of relief. So this program has examples of properties that are better off under homestead than they are in this program. But it also has examples of properties that are worse off. And so this one is less clear. There's certainly fallouts of forcing people to choose between them. If you did make people choose between this program and the homestead, anybody that chooses this program will be worse off after the homestead exemption is adopted than now, because the amount of their property value that is not exempted is going to be at a higher rate now than it will be in the future. But that still might be better for them than if they took the homestead and paid the 1.1% rate instead of the 1.35, if that makes sense. So here are my main takeaways. And again, I probably got ahead of myself on this, but so if you don't stack the programs, anyone in PTAP or Montana Disabled Veterans is worse off after the homestead. And that's just because when you raise we're raising the residential rate. And so these programs, people are already taking, a percentage off of a 1.35% rate. Regardless of if they're better off in the homestead program or the property tax assistance program, they will be worse off than they are right now if they're not allowed to stack. The difference in the rate differential between the primary home and the all others is what's going to determine if it's better for people to take the homestead exemption or the property tax assistance program in this case. But again, they will be worse off than they are now. And then Montana Disabled Veterans is generous enough, and it completely exempts people up to $50,000. So they would probably always still take Montana Disabled Veterans rather than the homestead. And then the Intangible Land Value Program, there are some people that would be better off under the homestead than they are under that program now. That one's a little more of a mixed bag, but happy to take any questions that people might have about this.
So a comment here to begin, then we'll go to questions. I can say my honest thought process was never to not have these stackable, right? In my worldview, what we were effectively doing is we were creating, through VI homestead exemption process, we were creating a reduced rate for owner dwellings, i.e. in example 1.1%. That ultimately these owner dwellings, that the changing of the rate from 1.35 to 1.1 should not disqualify you from PTAP, should not disqualify you from MDV, should not, in fact, it should have no impact at all. It would be as if the rate itself had just shifted. And that my argument was that, again, now we have to create a scenario that's doable and workable, but ultimately you would have two rates. So a rate for those folks who didn't qualify for it, that would be I guess truthfully, this would be available to them as well. In some cases, if it was their second vacation or whatever, I don't know, it wouldn't either. So basically, you would primarily just have changed the rate on a certain series of homes, and but ultimately, we do know that whatever decisions we make impacts these, and in my mind, it was basically we were reducing a rate, and these should all qualify in the past as they qualify now. Now, maybe they need some slightly different parameters, but that would be parameter conversations we'd have irrespective of a homestead exception. So I guess I would begin with that comment. Are there questions, thoughts? Senator Fern.
Oh, you muted yourself, Representative Fern.
You're muted, Senator Fern. Hey, Representative Fern.
Thank you. I agree with Rep Jones has just said. I envision this as making whatever the adjustments would be by way of a homestead exemption, and then retaining the programs we have, but adjusting them to the exemption. I guess my thought is that the folks who who rightfully use these programs are a relatively modest percentage of taxpayers in the state. And I sort of don't want to develop a thing where sort of the tail is wagging the dog. The first and foremost important thing is to look at, why we're here. And so attempting to use the homestead exemption as an instrument to lower residential prime taxes for primary homeowners seems to be maybe our number one priority. And then with that, the smart folks in the department will give us advice as how programs have to be readjusted.
Okay, Jeremy?
Yeah, just a question about the calculations that you've done on where there's that big map with all the different counties and how much the other residential property would go up under different scenarios. Did those assume that PTAP and MDV were untouched, or what are the assumptions about those programs when those other calculations are done?
Good question. So those would assume that PTAP is a part of the that the programs would be allowed to stack, because all these homes, PTAP and MDV, are primary homes. They would have been considered in what we've been using as primary homes when we adjust the rates. So true, the numbers that we've been giving you guys based on our model have these programs stacking.
Okay, thank you.
Okay, Rhonda, you had your hand up, but I see you must have put it down.
I was just going to ask the same question, but if they had assumed that the numbers were that the PTAP was the same program as it is now, and then also suggest that it seemed reasonable to just go forward with the homestead and then go backwards and pull these PTAP numbers and figure out how to adjust them so that nobody was hurt. And we just change those programs to adapt to the new rates with the homestead. That would seem the simplest way to do this and keep people from being hurt in the change. So basically, Representative Fern had said what I was going to say.
Okay. Mr. Story.
I just had a question for Dylan. When you do your analysis about better off or worse off in the programs, are you assuming that have you done any mill shifting there?
No mill shifting, but well, okay, yeah, good point. No mill shifting. It was specifically, I guess, looking at how much taxable value gets exempted from their house. So, so Mr. Story's point is that, maybe there's enough reduction in local mills that these properties are still paying less taxes after the homestead model adoption than they are now. When I'm saying they're worse off, I'm specifically saying they're going to see a lower percentage reduction in their taxes from the benefit of the program, which is maybe potentially different than are they better off in year 2024 versus year 2025.
I think it's just people on the margin, because you may be in cases where the mill levies go up. If you have a lot of owner occupied and take the taxable value down, the levies are going to go up. So people on the margin are going to be better off one way or the other, I would think.
Yep, I think that's fair.
Okay, I see no more hands up. So our thought process is, because we're going to have to go and incorporate this conversation. But what we did last time, and I believe I'd heard from a number of you, we tried to narrow in on a couple, because we got to start narrowing in on some possibilities. And so the direction I had pushed was to try to look at numbers that would get us in the neighborhood, because it moves around on you, in the neighborhood of a 15 to 20% owner dwelling property tax reduction potentially. And again, that'll vary a little bit by area, and a similar number on the small, because with the commercials linked currently, so we always have to play with the commercial numbers as well. And the concept that your smaller kind of your small businesses, the Homes Cafes on Main Street, your smaller businesses in a blended model would have a similar percentage reduction, and that we'll look at the opposing rates so that to the greatest extent possible, the system was self-contained, right? There's no perfect way to not shift something to other classes. And it depends very much on the county you're in, but to try to arrive at one where the shifting was minimalized. And when we looked at this, we played with it, looked at numbers. I believe the rates we had came up with was 1.1 and 1.9 and 1.5. Well, why don't we go through this where this came out, where we can see all the numbers, see what the shifting occurred, and then hold the conversation. The reality was, in order to be able to move this, this was the only thing we were seeing that was moving $100 million around, which, given that property tax is 2.1 billion, nothing else moves enough money around than doing something like this to have anything other than that we were looking at than either a trivial impact or a massive transfer. Center Story, I see, and we were going to go through this, but our Bob Story.
Well, I'm trying to lower my hand, but I can't get it to go down, so I don't.
Okay, I just saw your hand up, so I didn't touch my mind. So with that, why don't we go through it, and then we'll talk about it.
All right, I think that's me. So for the record, Eric Dale with the Tax Policy and Research at the Montana Department of Revenue. And so we'll get started. So here's some scenarios that Representative.
Excuse me,
Jones-
Eric. Let me interrupt a minute.
Shoot.
So we have moved on to the next item on the agenda. I just want that clear on the video.
Thanks, Ruff.
Thank you.
Yep.
Please.
So as I said, we started looking at some of these different possibilities and moving the dials in different direction. Here's one that we thought we would bring to your attention. So in this scenario, we set the residential rate, the primary lower rate for primary residents at 1.1, and then the higher rate at 1.90%, and then put a market value threshold of $1.3 million. So anything under $1.3 million that was a primary residence would be taxed at the 1.1% rate, and any amount over $1.3 million that was a primary residence would be taxed at the 1.9% rate, in addition to anything that was residential but not classified as a primary residence or a rental improvement, I guess. That $1.3 million is also 4 times the median value, is where that number sort of came from. And then on the commercial side, we set the lower rate here to 1.5% and the higher rate to 2.1%, and the threshold amount to at 6 times the median value, which worked out to approximately $1.975 million worth of value. So any commercial property with a market value of less than 1.975 million would be taxed at 1.5%, and any amount of market value over that 1.975 million would be taxed at a 2.1% rate. So here's where those numbers come out. So if we look at the table here, we can see that for primary residents, they would see a decrease in taxable value of approximately $201.5 million. That corresponds to a decrease in tax of $102.7.8 million. Similarly, residential rental improvements would see an overall decrease in taxable value of $91 million, and that translates to a decrease in taxes paid of $44.2 million. And then this all other category would see an overall increase in taxable value of $440 million statewide, and that translates to an increase in taxes of $170.994 million. Overall, class 4 residential values increased taxable value by 147.8 million or so in taxable value, and again, overall, that works out to an increase for all Class 4 residential property of $24 million. If we come down here and look at the commercial side of things, we can see that these small commercial properties, so anything under that 1.974 million amount, would see a decrease in taxable value of $51.4 million, and that translates to a decrease in taxes paid of $27.3 million. The commercial properties over that amount would see a slight increase in taxable value of approximately $800,000, and because of the way the mills shift, they would see an increase in taxes paid of approximately $4 million. In percentage terms, residential home sites, primary home sites, would see a decrease in taxes of approximately 16%. The rental improvements would be 17% decrease, and then the all other would see an estimated increase of approximately 38%. Similarly, on the commercial side, the small commercial properties would see a decrease in taxes of 19%, while the large commercial properties would see an increase of approximately 2%. If we come down here to agricultural, they would not see a change in taxable value because we haven't changed the rates associated with Class 3 property. However, because of the way the mills would shift in those areas, the overall taxes paid for these properties would decrease slightly by approximately $300,000. The all other category, which is not exclusively centrally assessed, but centrally assessed is the major component of that, would see an increase in taxes of approximately $6.4 million that is associated with that increase in mills in those taxing jurisdictions of 5.6. In percentage terms, the ag properties would see a decrease of 0.4% in taxes paid, while the all other category would see a dollar weighted average of 1.16%. These are statewide numbers. Again, as alluded to, this would vary depending on which taxing jurisdictions the properties happen to be in. So we also broke this down by county by way of an example. Again, we looked at Lewis and Clark County. So in Lewis and Clark County specifically, there would be an estimated decrease of $15.8 million in taxable value for primary home sites. That translates to a decrease in taxes paid of $8 million. In percentage terms, that's approximately 14.7% decrease on the dollar weighted average amounts. Rental improvements, same story, would see a decrease of $4.6 million in taxable value, and that translates to a tax decrease of approximately $2.3 million, while the all other residential category would see an increase in taxable value of almost $13 million, and that corresponds to an increase in total taxes paid of approximately $9 million, or 46%, 47% almost. On the commercial side, there would be a decrease in the small commercial properties of approximately $3.2 million in taxable value, and that corresponds to a decrease in taxes paid of approximately $1.8 million, or 17%. For the large commercial properties, so anything above this 1.974 threshold, there would be a slight decrease in taxes paid for these properties because that higher amount only applies to the amount above this threshold. So they would still see a decrease in total taxable value, excuse me. But because of the additional increase in mills, the overall tax impact for these properties would be an increase of approximately $500,000, or 3.48%. For agricultural properties, there would be a slight increase due to the increase in mills for Lewis and Clark County of $32,000, or 3.15%. And then for the all other category, there would be an increase of slightly less than $1 million in Lewis and Clark County, which corresponds to an increase of 4.38%. Here are the impacts for median value homes that are assumed to be primary residence. So here are the current law values, what those new values would be under these home site provisions, and then the excuse me, overall difference between the two. So if we look at the difference in taxes, I believe Carter County right here is sees the smallest decrease because the median value is relatively low of $50 in taxes paid. I believe the largest increase in this group is Gallatin County, which would see a decrease of $758 in total taxes. If we come over here to the percentage difference, you can see the taxable value change is equal for all counties. That is a result of this threshold at $1.3 million being well above the median value for every county. So essentially that 18.52% change is the difference between 1.1% and the current law rate of 1.35%. If we come over here to taxes paid, I believe Yellowstone County with a decrease of 14.09% would see the smallest overall decrease in taxes, and I believe Madison County has the largest at 27.74% overall estimated decrease in taxes. So those are median values. It was also requested to look at average valued homes. This tells a very similar story. I believe the Carter County, again, $64 is the lowest value with an average home value of $70,000. I believe Gallatin is still the highest. Yeah, $943 decrease in taxes on that $803,000 home. In percentage terms, it actually switches. Madison County would see a decrease of only 1.61% because the average home in Madison County is 2.5 million, which is above that $1.3 million threshold. But because of the way the mills shift in Madison County, there would still be a slight decrease for a home valued at that amount. The largest percentage decrease for average home, I believe, is Granite County at 25.77%. So that is available. We also updated the maps to look at
Ralph,
same
do you want to
information.
say something at this point?
Oh.
Ralph's got his hand up.
Although he is muted.
But he is talking.
My lips are moving, so sorry. So the issue also, Eric, isn't just a function of the median value home, the Carter County versus, let's say, Madison County, high and low. Is it also not a function of just the relatively low mills in some of those counties that have a lot of
Yeah.
property in them?
So
The residential share is a smaller piece of the pie, I think.
it's going to depend on the tax base in those particular taxing jurisdictions, right? And what happens with mills and everyone else, and so that sort of thing. And I believe you're probably correct that in Madison County there is likely to be an increase in taxable value, and that would result in mills shifting down, which is what the model shows here. There's a 32.71 decrease in mills. So when those two impacts are taken together, that's why that amount is somewhat smaller. So there is an increase in the taxable value for a property valued at $2.5 million, but when taken in conjunction with the decrease in mills, the overall impact is minimal for that particular area.
If you do your next slide, you can see county by county, right? It's the next, and then I see Dave's hands up. But what happens is every county's got a different tax mix, a different property tax underlaying mix. And then in eastern Montana, in some areas your residential is a small part and it's being backfilled. In other areas, it's a huge part. Plus the market value shifts in eastern Montana were substantially different than western Montana. And so there is it trickles across this strangely, but it does seem to work overall. Dave?
Thank you. My question is, realizing we differentiate some higher income, higher valued homes currently at a higher rate, But I do wonder how equity comes into play kind of when we expand this philosophy of breaking down rates by value, and it's so much prevalent. Do we expose ourselves to a problem dealing with equity?
So I'll say constitutional wise, everybody's paying the higher rate. Everybody's paying 1.9%. There's just a owner dwelling based upon if you are a homeowner, will you save a homestead exemption? So far, everywhere we've looked at deals, because everybody is paying in this example, our residential rate for the state of Montana is 1.9%. The,
Okay,
if you
that
qualify,
clarifies. I was unsure how, I guess on this model, how we actually were applying the homestead, and that's clearly the homestead makes it for some, brings it down to 1.10.
yeah, so it's, you are qualifying based upon you, just like PTAP. You're qualified because you're a homeowner or it's a long-term rental. The rate is the higher rate.
And will we be looking at a model that does the differentiation? This is splitting it up by the value of the home. Do we also look at splitting it up by whether it's strictly a primary home or a second or
This
third?
this model is doing that.
It is doing that. Okay. All right.
Yes.
Yeah,
To
and
qualify for the lower rate, has to be your primary dwelling,
Okay.
and you have to you live here. If you're in Montana and you're an owner dwelling, it's a primary owner dwelling or a long-term rental. Everybody in Montana is paying 1.9%, but a home that is an owner dwelling that or a long-term rental, those are harder to track here, but that's what we're trying to put in here, would qualify for a different rate.
Got it. No,
Like in PTAP, if you're low income, you qualify for a different rate.
very good. Thank you.
and
Yeah.
also just to quickly clarify, these median valued homes in this analysis was all assuming that these properties would qualify for the primary residence. If they didn't qualify, if they were secondary homes at these values, presumably there would be an increase in taxable value and an increase in overall taxes. I've been working on showing that, but haven't gotten around to it yet. I know that was something that was requested. So,
And the business one, the commercial one, it's very much like the business equipment tax. You pay the lower rate up to a certain value, and then the higher rate thereafter. So it's a rate for everyone.
That's good, because I was wondering if it was a cliff or not, and that explains it really well. Thank you.
all right. So yeah, this is the map that we showed earlier. The darker the colors, the more of a impact would be on a median valued home. So if you go a couple slides back, those median home value estimated changes in taxes are what is displayed on the colors of the graph. And then if we zoom in on these little subtables, if you will, it just shows the percentage decrease for primary home sites and rental improvements, all other residential property, commercial property as a whole, agricultural property, the shift in mills, and the overall tax increase from that county from all taxing jurisdictions. If we look quickly at distributions, and this kind of comes back to some of the things Representative
Eric.
Fern was talking about.
Rhonda's got her hand up. I'm sorry, I was
Rhonda.
looking at the chart.
I just have a quick question. Does the homeowner work the same way as the business, that if your house is worth 1.8 million, your homeowner exemption would work towards the 1.3, or is that a cliff with the homeowner one?
That is gradient. So if we come to this slide right here, it's a distribution of home values. And so if we look at these two dotted lines, these are the essentially the tax rates. So the orange line is current law, and here's what it would be under this presumed law. At 1.3 million, you can see it starts to go up, but it doesn't reach that higher rate because you're still taxing the amount under the threshold at the lower rate, and only the marginal amount over that threshold is being subject to the higher tax rate. Does that answer your question? Excellent. So yeah, that those are the tax rates that we were talking about adjusting. If we come down here, we look at the effective tax rate. So this includes not only the tax rates, but what the overall mills would be both under current law and under the new proposed law. So as we can see, there's a slightly higher effective tax rate at lower market value properties, and that starts to trend down. If we come down here to where the threshold is, we can see that gray line starts to approach that orange line and would eventually cross further out on the distribution. We, also looked at those distributions for commercial properties. So a similar story here is the overall rate under current law for commercial properties. Here's what it would be under the proposed Comstead exemption. Once we come out here to 1.9 million or so, we can see this starts to tick up, and eventually as we got further and further out on the distribution, those two lines would cross. And that also translates to the overall effective rate, which incorporates mills into the analysis. And so we can see those two lines come closer and closer together, the higher the market value, and then would eventually cross further to the right of the distribution.
Ralph has his hand up. And he's talking while muted.
I'll learn. Eric, can you remind us what the median commercial property was?
Yeah, the median commercial property was actually surprisingly similar to the median home value. I believe it was somewhere in the $300,000 to $350,000 range. Based on our best estimates, commercial properties are a bit harder to definitively characterize as to what's included in a commercial property, but based on our data, that's kind of what we were seeing.
So half of all the businesses are to the left of that 350K bar.
Correct. That would be a correct description of the median. So.
Thank you.
Yep. So these are some graphical representations. I also looked at some counts. I thought that might be helpful. So here I went through and counted the properties in different categories. So in our model, we're assuming there are 215,000 properties that would be classified as primary residence, 213,600 would anticipate to see a decrease, while 1,600 would potentially see an increase in taxes paid. 500 of those properties would see an increase of over $1,000. 180 would see an increase between $500 and $1,000, and 975 would see an increase between $0 and $500. On the decrease side, 124,000 approximately would see a decrease of between $0 and $500, while an additional 78,000 would see a decrease of between $1,000 and $500 in ad valorem taxes paid, and an additional 11,800 would see a decrease of over $1,000. I also put those in percentage terms. So again, 14 properties would potentially see an increase in taxes of over 25%. 163 would see an increase of 15 to 25%, and 1,478 would see an increase of between 0 and 15%. On the other side, 81,000 would see a decrease between 0 and 15%. A majority, 127,000, would see a decrease between 15 and 25%, and an additional 5,250 would anticipate to see a decrease of over 25% in their ad valorem taxes. Similarly for the commercial properties, so in this model, we are assuming there are 33,000 total commercial properties spread out across the state. 32,000 would potentially see a decrease, while an additional 1,172 would see an increase. 921 would see an increase of over $1,000 in taxes. 101 would see an increase of between $500 and $1,000. And then 150 would see an increase of between $0 and $500. Additionally, 13,000 would see a decrease of between $500 and $0. almost 7,000 would see a decrease of between $500 and $1,000, and then 12,000 would see a decrease of over $1,000. Coming down to the percentage side, we would estimate that almost 1,600 would see a decrease of over 25%. 28,500 would see a decrease of between 15 and 25%, while almost 2,000 would see a decrease of between 0 and 15%. However, there would be an increase of between 0 and 15% for 1,147 of these properties. 23 properties would see an increase of between 15 and 25%, but we did not find any properties that would see an increase of over 25%, if that makes sense.
Mr. Story.
Yeah, I just wonder of those over 1,000, I mean, what's the top increase? Do you have that number?
I don't have it off the top of my head, but I could certainly get it for you.
It would be between 15 to 25%, right? The maximum is 25 because you have 0 over 25.
Yeah,
So
so that $1,000 increase or whatever it is over $1,000 would represent something between 15 and 25% increase for those particular properties.
But that might be a lot of dollars if they're, I mean, that's what I have.
Exactly.
What,
Yeah.
I think that's less. If over 1,000, you only have 921 over 1,000. So if you go, that means most of them are actually less than 15%. There are only 23 that are 15.
There are 23, and so yeah, exactly. The percentage in percentage terms, there's only 23. So this over $1,000 must represent a relatively small amount in percentage terms because there are no properties that saw an increase of over 25%. If that makes sense.
Yep.
Wanda?
Do we have this somewhere that you sent us that we can see these numbers on our desk so I can flip back between pages? It's going fast enough that I can't do the math in my head.
Yeah, apologies.
Yeah.
The presentation
They are posted.
is posted. Yeah,
And it should have come in your calendar invite as well.
Excellent. And some of those county specific ones are posted, so you can review those at your leisure.
So basically what this is showing, there's going to be rounding numbers. This is going to, there are 215,000 long-term rentals or owner dwellings would receive a decrease in taxes.
This is only the primary residence, so the long-term renters aren't included in any of these numbers because we currently don't have a great way to
Okay, so in that case, so 214,000 primary residences would effectively see a decrease. Now, we don't know how many long-term renters, but that's one of the things that would be included. So 214,000 would receive a decrease. And then how many on the other side? 33,000 or so. What was the next page?
32, yeah.
32,000 small businesses, the median being around 18% on the decrease of taxes, right?
Mm-hmm.
The taxes decreased was around 18% and slightly higher on the commercial. Am I summarizing correctly?
Yep. So yeah, 19% for the typical small commercial property.
And 16% for the home site. Okay.
Yep.
All right.
Yep. Can you go back to that again? I think the statewide again. Notice the long-term rental improvements. We think they have similar tax reduction.
Mm-hmm.
17, 18%. We just don't have a count of them.
Yeah, it's difficult to determine a meaningful account because there can, for a host of reasons, but one of which is, there can be multiple units within some of those properties. So,
and we're only discounting the improvement value.
It's true.
So,
Jeremy?
Yeah, Eric, is there a way for you to do the distributional, the increases, decreases for non-primary residences? So for those that will be seeing the increases, can you do that, or is that because they didn't get the rebates, right?
It is much more difficult. We can look at properties and try and that is something we've been thinking about and haven't come up with a real great way to do it, because that is one of the squishiest areas of this model, is isolating the rental properties from everyone else. Essentially, that's not a rebate property. So,
Okay, thank you.
you know,
Yeah, because the payers are going to be effectively twofold, right? The payers on the residential side, obviously there's going to be shifts between classes. Accepting that, on the residential side, you're the 21% of the tax value that's going out of state is not going to, likely a significant portion of that's not going to qualify as an owner dwelling, but they're still, so they're going to pay more. They're now the argument, if you're not living here, is that you still benefit from public safety, which is, you know, when I listed the three things 93% of our income tax goes to. You're probably benefiting from a hospital. You're probably benefiting from a police force and having a prisoner off the street, and you're probably benefiting from an education workforce, which are paid for by the W-2 income taxpayers in Montana as part of the system. So you are receiving a subsidy from the income taxpayer that does live here at some level. And so whether that's the equitable amount, right, I don't know, but that does, I know a lot of states are looking at a differential that way. You know, and of course on the commercial side, everybody gets a blended rate. But if our intent is to help keep these small businesses along Main Street alive and viable in a world increasingly facing some of the ability of the larger ones to do e-commerce, etc., it was met some of the conversations we had as the goal to move enough money significantly around to be able to address this. You don't move $100 million around without somebody paying more. That's just how it works. Rhonda?
I'm just a little questioning, and that's why I wanted to go back to that number. We are only having 215,000 households, and the Census Bureau says there's 357,000 owner-occupied households. So we're missing some number there. I'm not disagreeing with the policy. I'm concerned that our numbers don't add up.
yeah, so the numbers in this model were based on the rebate numbers and the properties that we identified in 2023 that received a rebate, the tax year 2023 properties that received a rebate. We also had some problems with that. Presumably there's just a host of reasons that I don't know if Dylan wants to get into, because I know he's looked at that much more extensively than I have. Not to throw him under the bus here real quick.
Yeah, no worries. Yeah, so I wrote the fiscal note for the rebate, and I estimated 300,000 rebates based on that census number, and the number came in at 2/3 of that. I really can't find a great explanation of why that is. So I think it's a fair criticism of this model to say that we're undercounting primary residences.
I think we might see
although-
that adjust this time though too, right? I'll
So-
bet you more
Yeah,
people will ask for the rebate this time. So this model, because a lot of times I had folks up here say, oh shit, I forgot to do that. So I'm guessing more folks will apply now.
Yes, we're hoping to have, so there is going to be another round of rebates. So, that's even better data. It's another point in time that we can compare to and we can use to refine this model. Maybe there is some difference in methodology of what the Census Bureau considers a owner-occupied dwelling versus what we are qualifying the rebate on, and presumably what we would qualify the homestead exemption on. I think it's fair to say that the criteria for this homestead model that the department would use is probably pretty similar to what we required for the rebate. So I guess my belief is that the rebate numbers are still the most valid data point we have. Certainly a fair criticism to say that maybe we're undercounting though.
Okay, and I didn't mean to stop you before you got to the end of your slides or where
Oh,
you-
actually, that was the end, I believe. And while we were sitting here, yep, that was the end. I did want to look and try and answer Bob Story's question. It looks like a refinery in Billings that would have the potentially the largest increase in taxes under this model.
Mr. Fern, Representative Fern.
Thank you, Chairman. Are we going to engage in a discussion or demonstration of manipulating these numbers to see what they do? In other words, the 1.10 and 1.90. Would you call those arbitrary numbers, or, you know, numbers that the department has studied and seems to be kind of the sweet spot?
The model itself can have any numbers set in it, right? So the model can have any numbers set in it. I was the one that dictated towards these numbers because we're coming up to have to do a report somewhere, and so that where these numbers came from, and I'm going to round now so that I'm sorry if I'm a little bit off, but I believe taxes statewide, property taxes, residential, wasn't it like a 21% tax increase in DOR statewide? Is that correct over this last time? The market value went up more, but didn't taxes go up 21%-ish? Am I correct?
That sounds about accurate.
Right. And so the where the 20% target came from was a thought process as stuffs do increase in value. But if our goal was to say that this market value increase driven somewhat by out of state demand, et cetera, was abnormally, then we were trying to correct for it. And 20% was what, you know, on average, the number went up. So that was, the search was for several things drove my numbers. Was one, search for something around that 20% or slightly below it, because taxes do go up because goods go up. Some number in that range seemed to be thoughtful. So this was correcting for that number, right? And then finally, the other thought is we can make up all sorts of things we can do, and we can try to shift more top and bottom. But in the end, we have a magic called 2651-1. And the magic of the legislatures has to be something you can sell. And so as we were looking at the distributions that came up before, I believe it's sellable to say a 15 to 20% tax decrease for 215,000, maybe more, owner dwellings. And these are arguments you could make, right? And potentially have a chance of actually having to pass the bill. Because we know what's going to happen is folks that are on the other end of this are going to show up and make an argument, right? And if I have a $50 million home somewhere, I would rather not pay more taxes. That being said, I'm going to also make an argument you're not paying for your entire public safety, you're not paying for your education or school. So yes, those numbers we have about a month. We're going to have to target towards something. We're probably not going to be able to move much more percentages around reasonably than that. It was matched with what taxes went up. Those were the driving factors. Plus, listen to the conversation here on what folks were saying about owner dwellings, long-term rentals, and recognizing that because you try to associate the level of services required with who pays, right? But how do you link the value of the income tax service? That's 93% of all our income tax goes out and buys services in these communities back to the folks not paying income tax. We're going to have pushback from vacation dwellings, second homes. I have one, right? But I get a lower rate on my primary and pay a little more on my secondary. So that's the best explanation, because when we came up with where to go, that was a conversation I pushed. The model can be adjusted to any number, and I'm sure that in a session it would be, but we have to produce some recommendation. Mr. Franklin, your hand is up.
Two, I actually had three, but I can only remember two. One on your cost side, I think we need to remember that there are fire costs, and a lot of these higher value homes are often in the urban wildland interface. So on your cost side of public safety and other things, that's something you might want to consider. And then we don't have public comment scheduled until the end of our work through, I think. But perhaps before we go into toying with the testing various scenarios, you might want to open the conversation to public comment, since there have been some non-committee member commentary during the course of the conversation.
Yep, I'm happy to have anybody weigh in. I was just answering that question. So
Yep.
whoever wants to, because we're going to talk about a path forward here, but additional comments at this point or thoughts are welcome.
All they need to do is raise their hand and we would promote
Raise your
them.
hand.
I just thought we should give them an opportunity. Every now and then we get a good idea. Okay. I don't see anyone raising their hand on the attendees. So do we want to move on to the next section of the agenda? Oh, I did see a hand go up.
An attendee's hand has gone up. Just a second here. I got to click over there to see who it is.
It
telephone.
doesn't have a name. It's someone calling in.
I think
Brandy,
I'm
can you-
calling.
Yes.
Perfect.
Can
Your
you
number
hear
ends
me?
in- Yep, 377 is your number. Yes.
Okay. My name is Jeannie Rhodes, and I live in a manufactured home in a park, so I don't own the land. Will people in my position qualify for homestead exemption?
You own your home. Yes.
Yeah, I own the home.
Yes. Yes. It's owner dwelling. So yes, you'd be an owner dwelling.
Okay, thank you.
Additional, we got a hand up in the other column here. Just a second. David.
Yeah, I
Representative
think there's, if I'm not mistaken, I also think that there is an added exemption for mobile home owners based on age. Does anyone recall that?
Oh.
Your value goes down at a certain magic number in the age of a mobile home. Am I making that up, or is that real?
Well, it used to depreciate on the title, but that's
So there's currently a program so mobile homes tend to depreciate more than real property would appreciate in general. And then in addition to that, if a mobile home is over 25 years old, I believe, and under $10,000, it is exempt from taxation.
Yes, 28 years or older.
28 years.
it's exempt at 28 years. Okay. Rhonda and Bryce has got his hand up as well, and Rhonda. So
I just got a couple of general comments, I guess. One, we are gonna, if you want to include mobile homes, we are gonna have to do that specifically because they are taxed differently than residential real property unless that mobile home is on a foundation, in which case then it becomes real property. So mobile homes in a park, we are gonna have to address. It's not that it can't be done, but it doesn't get done in an umbrella. So you need to remember that they're taxed differently, a little bit differently. Also, I want us to think, and I'm not opposed to this idea. I do think it's probably the most successful, optimal way to go forward, but it isn't. I want to make sure we're not over-promising and under delivering, because I can see areas. So I like Lou, the cabin in Lincoln's going to go up in taxes. That's probably okay. I pay like them to do fire suppression there. But Lincoln residents are going to do really well under this. If you live in Lincoln, there's lots and lots of cabins there and almost nothing. So many of them are second homes. I'm now thinking about the fire district that I live in Sun River, where I can't mentally, going down my cadastral list, find anybody that's a second home. There's also almost no business property out there. So the taxable value is going to drop in my fire or my school district, not necessarily in the county-wide, but the taxable value is going to go down substantially, which then they're going to raise their mills back up. And I'm not sure that the homeowners, when there is no second housing, are going to get as much of a benefit in those small districts. Countywide, you might be fine, but when you're looking at those small fire districts, those small improvement districts that are in different areas, you could end up with those where they basically raise their mills back up to a pretty hefty level to get back and those layers. So it's not just going to be one, it's also going to be the transportation for the buses, and it's going to be some stuff for the schools. So I am a little concerned about that. And I do hope we can find another way to look for numbers, because the difference between 357 owner occupied thousand and 215,000 is more than just a margin of error. Or if I recall, my economics teacher would have thrown me out, not past me on that margin of error. So I do hope we can find a way to, I don't know exactly how to do it, but if we can figure out a little bit closer number to how many of these there are, because at that high a number, it could seriously change our numbers.
You're muted, Lou. Representative Jones.
No, I'm not.
Oh, you were far enough away. You were out of your microphone.
That might be, I just said, Ralph, your hand's up. Okay.
So, to that effect, I think with Eric's data, we have those numbers by levy district. We can see if there's any districts where the risk that Rhonda has pointed out about being so many primary homes making up a tremendous percentage of the taxable value in the district that the mills would float up enough to offset any of the gains. I think we can test that, but Dylan and Eric will have to answer that. And then on the census data thing, I think Dylan was pretty clear. We're going to get another shot at it. Plus, we have a very strict definition of what counts as a primary home, of being more than 7 months. And we don't know we'll have to dig into the census definition of what constitutes an owner-occupied home. But my guess is that those are a lot of part-year non-resident homes that got swept into the census numbers. But we can check that, and it could be some of the rentals as well. But I don't think the margin of error that is as big as that 100,000 home gap. I don't think is. I think it's explained by other things. So I don't think we have as big a risk there, but we can test.
Well, and the third thing, and then I'll go. A third thing we'll have to deal with is depending where these numbers land, they're going to change what the state mills bring in, and we're going to have to hold a conversation there, because the intent here wasn't to have the state mills bring in more money to the state. So obviously we would have to either just directly click the GTV number higher, or change the number in 587 so it pushed harder. And to those areas that are school districts, no matter where you exist, if you push on the GTB number, it pushes more money out to where the schools are, where the transportation is. Because if I remember right, this thing was bringing in somewhere between $6 to $12 million more to the state. Is that correct?
I thought we got pretty neutral, and that was sort of one of the things we played with too. But Eric, do you have the number?
Whoops. Yeah, give me one moment here. Sorry. I believe it was approximately $10.5 million preliminary estimate. Would be the increase for the 95 mills and the 6 mills.
Yeah, and so obviously, well, the 6 mills are the 6 mills are voted on, but on the 95 portion of that, which would be the lion's share, that would be, a guy could just take the GTB number and click it higher, or which again pushes that money back out to those areas with schools. So Representative Fern and then Mr. Story.
I fully agree with Rhonda's sentiments. It's one of those things you wake up at 3 a.m. thinking about. But one thing that might help is I hope we see the study come out that looks at those 160-acre plots of land and more that aren't being utilized as intended. And when I think about that, I start thinking about the location that Rhonda was citing as, you know, those are this example of where some of the rural folks who really don't have these second homes, either in-state owner or out-state owner, that might be adding added value in a sense to their tax base because of all these use of 160 acres plus that aren't going to agriculture. Possibly at some point that can blend in to yield, you know, better results around the state. But I think the problem we have with this model is it may be the best you can do in that, you know, there's going to be some folks where it's just neutral. What I like about it is it provides relief to many of those communities and counties and municipalities that are really facing the impact so severely as cited.
And there's an ag group working on the ag challenge. Actually, Cindy Johnson was on earlier and she's part of it. So I don't know where they've arrived at, but there is one on the ag challenge as well. Mr. Story.
Thank you. I just wanted to offer two cautions kind of along Rhonda's line of thinking. First of all, the percentage reduction you're working on mitigates the tax increase that happened last reappraisal cycle, a huge increase. And so by the time this goes into effect, you're going to see another reappraisal cycle coming on, which you'll have some time to work with in this model, but that will impact people to some extent. And then the other thing is you're just mill inflation that happens because the school's got a 3% increase in their budgets, and the local government right now at half the rate of inflation, which will be going on also. So some of those will offset some of the potential tax savings in the current model that you're working on, but you have time to deal with those when they come up.
Yeah. Well, and appreciation is going to continue, right? Schools are going to get their funding. The other thing that's outstanding, and it's a more difficult question to answer, and I have some of those as well on the farm and ranch. A lot of homes are held in their limited liability companies. Now, you're not holding them in a limited liability company because it's a bad idea. You're holding them there because you get to write off roofs and furniture, and you get lots of expensing because it's in your company that doesn't exist for Representative Fern's house, for example. I just saw your face, Dave, is why I brought you up. So obviously there's going to be an argument made that should the LLC homes be included in this and could get the homestead rate and continue to receive the expensing they receive. Or, I mean, so those are all points of discussion because there's going to be a number of those homes held in companies because that is a beneficial way to hold them and keep your taxes lower. So lots of conversation points, but I am pleased with the beginning of this model. Representative Story, Bob, do you still have your hand up or you just didn't put it down?
I do, but I messed up my screen here and I can't get it lowered right now. So don't worry about it.
So, additional thoughts, comments, questions? All right, that's Bob's hand. All right. So
do we go to the simulation? Do we want to play with the rates a little bit? That was the next section on the agenda, is my understanding.
We can play with them, but a challenge with playing with them on the screen is all that happens is you get a very narrow readout on the screen that you don't have time to analyze. So I'm happy to show how you can play with them. but I'm not sure the beneficial of just magically making numbers up here is going to be. But yeah, let's show the system how it works so folks can see you can play with the rates. Right, because
Thank you, Eric.
You can change this to whatever you want it to be. There's a general fund disk right there.
Maybe you want to ask the committee, maybe they have some
Sure.
ideas.
So this is an Excel spreadsheet. We zoom in a little bit so you guys can see better. Here are the numbers that sort of feed everything. So these are the dials, if you will. So like I said, we set these to 1.1, 1.9, 1.3, 1.5 for commercial, and 2.1 for the higher rate, and those thresholds, and you can adjust those, and then all that same output will be spit out. It does take a little while to run, about a minute or so, which can, in a committee hearing like this can take longer than you think. But if anybody wants to reach out to me individually too, I would certainly be willing to work with anybody's desire to see the impacts of alternative sort of scenarios.
Certainly, if someone's got one example, because it takes a bit, they want to just see pop up. Say some numbers, and you can watch it work once. Does anybody out there have something they'd like to see? Jeremy?
Well, one thing I'll just mention before we start running all the numbers is, one alternative way of doing a homestead exemption is to provide a 0% rate for a first, say, $50,000 or $100,000. And we've mentioned this a few times in other meetings, but that's actually how most states do it. So that might just be another, alternative way of doing this to consider. I think, one reason
this model will do that, right?
It will do that. You can
Earlier
put a
on.
0 there and then put the first threshold at 50 or 100 or whatever. I think, one argument for that is you can actually provide a pretty big tax cut for the median home without shifting so much of the burden to other types of property. Because if you provide a $100,000 exemption, well, in some counties the median home pays nothing then, right? And that's Texas does. That's kind of the high end, but most states are around 50,000. And for the median home, then it provides a pretty big tax cut. It won't then provide as big a tax cut for the $1 million home, but there's also less shifting if you do that. So that's just one. If we're going to start running numbers, just to think about that as something else on the shelf as an alternative.
Yeah, and we ran that. That was actually the homestead exemption that got proposed last year. But when we ran that last year, it had massive shift to commercial.
Yeah.
And other classes. It shifted to the other classes hard. But we can do that.
Ralph, did you have something?
Yeah, I think the other thing we need to pay attention to here is in this design, we worked pretty hard. As I understood when the committee was talking about things and then talking with Representative Jones, you'll note that there's actually relatively little shift between the classes. The shifts are within the subclasses of residential and commercial. But looking at the table that Eric has up here right now, you can see that the total difference in tax for residential property is only 1.8%. And that's where that $10 million comes from. And then commercial, it's down 6.6. But if you look at the ag and all other stuff, it's pretty small. Those are less than 2% shift statewide. So the crafting of this was done pretty carefully to try to minimize cross-class shift.
Well, especially because market value of residential in Montana is 75%. Did this thing kick yet?
There it goes. All right, so here would be the example of a $50,000 exemption, excluding renter improvements, and then leaving everything at current law. So you can see the only shift here in taxable value is that 11% decrease weighted average, and they would see a decrease in taxes of 9.4%, but there would be a shift for all other properties right there. And then there's the county breakdown that we can look at. We also have the median home value difference. It's going to be a little all over the map, as member Horpendahl suggested. You know, you're going to see decreases in taxable value in areas with low median home values. Carter County, for example, is going to see a 90% decrease because the median home is worth $55,000. So almost all of that is going to be exempted. Whereas if you look at Gallatin County with a median home value of 646, they would see a much smaller decrease in value for whatever that's worth. And then here would be the map as well. As you can see, there's much more of a shift into some of these more rural areas where the median home is substantially less than the statewide
Well, and
average.
if you look at where the impact shifts, go back down on that. If dark red, so we had a problem in western Montana, right? That was where our primary problem existed. It was the Gallatin. It was, well, primarily the western 60%, where the move-in occurred. And so when we had the previous map, the darkest red where the most reduction occurred was in western Montana. If we do this model, that
I think you leaned too far back there.
Missed that last bit, Representative Jones. You're outside the microphone zone.
Oh, I'm sorry. My point. So the biggest market value increases in our current problem were in the western 60% of Montana, and so what I hoped to see of a model was that's where it had the biggest reductions, because that's where the biggest problem occurred. If you take a look here, what occurs is, you know, when you redo the model this way, in eastern Montana, in fact, right up in the far east corner, there was a 0% market value increase. So we're actually start cutting taxes where there was no tax increases. We did play with this, Jeremy, last year and tried to figure out, but that model seemed to, our lowest market value houses tended to be more eastern overall, and the lowest market value increase tended to be more eastern. The large market valued houses were more western, where the move-in occurred, and their median values were substantially higher. And so it didn't appear to hit where we needed it to hit very well. And then in those areas that if we were to pick an area and look at commercial in the east, in some of those eastern areas, because there was no market value increase of the houses, it dumped it hard to commercial and ag. Well, we can play with the model, but does that make sense? When we were looking at it, why that model didn't seem to work? Because I looked at those other state models as well and played with them and thought, man, it just doesn't seem to work here, because we were acting like two states instead of one state.
So
Yeah, no, I understand why that does the way it shifts it around is a lot different than the other method. So I think it's just I can see why that may not have looked attractive at the time, but you know, doing it this way, what it effectively does is it gives everyone the same dollar value of a credit, essentially, right? Everyone goes down by 1.35 times 50,000, whatever the threshold is. So you're giving everyone regardless of what their increase was over the past 3 to 4 years, you're giving them a $500 decrease. It's an equal dollar amount.
Yeah. So here we can see, well, this is mean, but yeah, there's $675 decrease in taxable value for every property here.
oh, everyone's below the.
Mm-hmm. Everyone's above the threshold. So.
Representative Fern.
Thank you. I think philosophically, I like to think of the approach we're trying to take as sort of a value-added tourist-based revenues. And, I look at the second homes, especially the ones we're delineating as out of state, as sort of an extension of visitation and tourism. And we struggle as to how to get sort of what we consider our fair share statewide from visitation. Obviously, we're missing the mark. So I think we're on the right track as far as the numbers that are being created. I would be interested to see if the rate was like just increased to 2.0, a slight deviation. And would that have a more significant impact, anticipating, growth in values and that sort of thing, and just seeing what the difference is. And I'm guessing it will just be more of a impact, on those 1,600 homes or whatever, and seeing what the actual difference is.
So Representative Fern, are you asking Eric to load that model up and try to plug in that 2.2 rate as the top rate?
Yeah, so I'm asking, and maybe, as homework for all of us, or you can send some figures, you can send some models to us that just deviate a little bit and then show the red maps, the statewide maps you have, just to sort of fine tune it. So we're making a recommendation with numbers behind it. And obviously, if it's accepted and comes to be a bill, those numbers can be massaged moving forward.
Yeah, and I think that a bill is going to end up being a concept, and the numbers will probably be played with significantly throughout. But in general, I think the concept works. I think the concept is going to have to not be, I can't see how you can say choose PTAP or Homestead. I think the Homestead exemption is going to have to exist, and then the other ones are going to have to integrate with it. Those can't be either ors. That doesn't make sense to me, how they could be either ors. Obviously, folks are going to need to weigh in on where they think the numbers will be, because at some point the question becomes political, right? Which is 2651-1. I personally believe that you're going to have to be pretty close to the 15 to 20%, or you're just not getting that vote. But I don't know. Senator Hertz, you've been quiet through all of this. What is your opinion?
Yeah, thanks, committee. No, I think we're all on the right track. I really like this program, but as you just pointed out, we're gonna have to run some models, and we're gonna have to see what type of relief the legislature is looking at for these primary homeowners, and that'll be the sweet spot and where we'll be able to move forward.
Ralph?
Two things. One, it just dawned on me, and I don't know why it took so long, but all those other residential properties, the second home type residential properties, probably are already in the areas that Representative Fern mentioned of high tourist impact. Where do you put your second home? You don't put it out in the middle of a field somewhere. You put it in some pretty place, generally in the forest, generally in the west. So there's probably some congruence of that helps carry its indirect as well as any non-residents. And then I think for us as the analysts, it would be very helpful for us if the committee could give us some guidance on what kind of sensitivity model you would like us to run. Just give us some broad guidelines on, hey, can you run it 10% higher and 10% lower from the current numbers? Can you shift the thresholds around a little bit? If you could give us some guidance on that, then I think the department can run those models, generate the tables and that we've seen in these presentations, and then you guys can look at the 5 or 6 or I think that's 8 simulations that probably implies. That would be very helpful to us because we're not the people who make policy.
So I guess at this point, I personally have a comfort level where the current model exists as a starting point. but I want PTAP and that to be additive, not alternative. But others can certainly propose differences at some point here. I guess I would begin by saying, I think this model has some merit because it's actually targeting, as Representative Ferd said, it's targeting the relief to where the impacts truly were better than most others did. I had tried, I like it being tied to some function of median value so that it's dynamic, because what's ever always happened up here is once you get a number that's fixed, the world moves away from it. And then you can never get it changed. It's a big, huge tax policy to change it. So I would want to have whatever that, 4 times the median value is what I picked for the home that allows a Bozeman or an expensive home to be under it. Obviously, we choose something else, but I guess I would like it to be 4 times the median amount. Some dynamically moving event that moves in time, so it's not just an item that becomes fixed and forgotten. Other than that, I mean, it just comes down to playing with the numbers, right? Is if there's something that, with the understanding that whatever we do, we can all create numbers and make our area just look wonderful. And then when we go to get lots of special votes, it's difficult to get. So whatever numbers we want to propose, I guess step one, a comfort level of the model, and this model will do the 0 1. And I appreciate the concept of every taxpayer gets the same amount. The challenge we have here is every house in Montana certainly went up way different. So I'm not sure that fits this current scenario. But again, whatever models people want to produce, we can hold a model discussion and ultimately go forth. That might be something we have to do almost on our own, I believe. Thoughts at this point? Mr. Story.
And you're there you go.
Well, I recall it. Eric, didn't you have a sheet that you handed out to Rick the other day that had about 20 different scenarios on it?
Yeah, that has been created already. So there are several scenarios that you can look at. It doesn't have all of the information that it was in this particular example, because you're essentially comparing scenarios as opposed to comparing, counties or types of properties or something. But it does have several of them, and we can certainly add to that.
Okay. Representative Fern.
Thank you. I think also keep in mind, what's the future of your bill with the 95 mills? Do we plan to adjust that? Because that was a major contention, with the counties. And nobody knows about this bill until late. When I explained it at schools, they didn't even know it existed. But, do we add more value to that bill especially in times of appreciation, to work the 95 mills, to the GTB or to retirement or whatever to, help in the issue. I mean, I think that's part of the overall solution that should come into play.
So actually, Representative Beatty and I had this conversation to bring folks up to speed a number of times of how to integrate them. And so, because that's in Representative Beatty's section, he was on earlier, but he's gone now. And unless something's changing in his section, he was going to pursue concepts. The one thing we're going to have to address initially is whatever we do could have a one-time, when you make this change, it could kick 12 million, 10.5 in my model, into the state. We can adjust that out simply by changing the GTB ratio once, right? That zeroes that out. Dave's process, which again helps where the schools are and the kids are on this deal, is his discussion, unless it's changed, is he's looking at changing that 55% number in 587 I know he was modeling 75, 80, 85, 90, some much larger percentage of that going back down the property tax line, so that if something like this were to occur again, more of the impact of the delta would directly buy down permissive mills. And he's also been modeling some GTB ratios. The other thing Dave is looking at that I believe holds merit is with 397 districts, school districts, he's looking at, is there a possibility to equalize the base mill at the county level, so that right now we have, within a given county, you have some area paying no mills and some area paying a lot of mills. If you equalized at the county level, then redid the GTB formula based on a county deal, it would do a bunch of smoothing of some in-county problems we have. I don't know where he's got on that model. I did weigh in on it a bit back when they asked questions, but yes, the 95. So what I see the key players becoming is this model, something to do with 587 to potentially deal with the 95 mills, something potentially to equalize across county lines with mills within counties to deal with that challenge. And then I know Senator Hertz, who can speak for himself because he's here, is looking at, is there a responsible capping that's not half the percent of inflation, but still provides some comfort level that things aren't getting out of hand. Senator Hertz, you're still on. Am I missing what's going on?
No, you're correct. So yeah, we're still looking at more or less the Senate Bill 511 model from last session that caps overall growth at a certain percentage and allowing full inflation. Also looking at modifications to and exploring the PTAP programs and some things you guys went through today, along with looking at some limitations on TIFs.
Yes. Yeah, we have a TIF challenge. If you think about, I had a gentleman call from Missoula that said, well, if we use TIF on a field and we build new houses in the field and that's part of the school, then when they did their tuition levy to pay for the school, the person in that field thought they were voting on a tuition levy that was going to help the school, but in truth, it helped the TIF. And so there's some challenges we have to deal with within the TIFs as well. Mr. Franklin? You're muted. I lean too far away and you mute. I lean back when I think.
Thank you. So I have a couple points here. I think you guys have covered very correctly what's going on in the education subcommittee as well. I know that the department and the LFD and OVPP have been talking about ways to link the effects of these models together so we understand the true cost and the shift. So there is some work there. I think some of that will come out at the education subcommittee meeting on Thursday, and everyone is going to, and I'll remind everyone that we're all going to be reporting out at the June 4th meeting of the full committee. And in the local government committee tomorrow, there's going to be a couple draft recommendations that we're going to discuss how we're at least applying the template. So there may be some interest in following that, and that would probably be something we'd report out at the PTAC meeting. I think I would like us to continue to, if any of the committee members can look at the other sheet that Mr. Story reminded us of, all the prior hard work the department's done. And if you have ideas for scenarios you would like to run, can you please send me and Eric your idea of what you would like a scenario on? Those emails will become public record. So if you will do that. And I think that is all my points, other than I will remind you that we probably should do public comment.
Okay. Let's see if I have. Is there any public comment at this point?
Let me get the participant list up. So we just need people who are online to raise their hands if they would like to say something. I see Mako's on there. That would be interesting to see how they feel about what's going on here. So,
Okay. All right, well, I guess we'll report out then. This presentation, you obviously might have to abbreviate it for the full group, but this presentation is probably what we'll generally, or an abbreviated version of this. So I guess I'll ask a question for, is there any disagreement out here? I can't see that it should be an either or choice between like PTAP and a homestead exemption. Is there any disagreement with that? Right, if you qualify for PTAP, you qualify for TTAP irrespective of what the rate is, etc. So I think with that thought in mind, I don't know how much of that presentation we have to do, because I don't think it makes sense to say you're going to choose either or. Senator Hertz is working on that as well. I think it's going to be, there's a rate, and PTAP is what PTAP is. Senator Hertz?
Yeah, I think the only thing in regard to that is probably need to discuss with the department on the complexities. If we had a homestead exemption and then you add the other property tax relief programs on top of that, it's just a complexity of calculating.
Yep, so we'll have to go through that. But I think policy-wise, it makes little sense. But other than that, I think this presentation made sense, and people are free to build any model between here and there they want, because we'll present out where we're at with this model, where we're at here, and then if something jumps out at someone when they're looking at it that makes more sense, that better fits Montana, and we think we can actually pass, all those things need to matter, by all means. I think, and thank you guys in the department for this. I realize making all these things happen, which seem like magic on the screen to us, takes a whole lot of time in the background. Thank you all for working on this so very hard. But unless someone else has got something to say, I think we'll charge ahead with that.
So,
Jeremy?
can I just ask one question about whether there's a scenario you can run? Mentioning you guys have done a great job, but so it was mentioned today that perhaps there are a lot more homes that would qualify for this than this model currently incorporates. So could you say, well, let's say there were 300,000 homes that would qualify for this, how would that affect the numbers? And let's say that, the distribution of those values is similar to the other ones. Is that something you could do, or is that just too complex to do that sort of analysis? Just as an idea of, that exemption would cost a lot more, right? If there's 100,000 more homes. And so that would then, the other revenue has to come from somewhere else. So
Yeah.
is that something you could do, or is that just too?
It could be
out there?
done.
I don't want you to spend hours doing it, but
yeah, the system isn't currently set up
Yeah.
to do it that way. And I feel like the rebate data is the best data we have available that we can tie to.
no, I would agree with that
presumably,
too. I'm just
yeah,
wondering.
that this program would be established where you would have to apply in a similar way to the rebate.
Right.
However, that being said, like we could start to look at that. I don't know how complicated it would be, number one, and number two, the reliability. I mean, it's difficult for us to sort of determine how many of those type properties are out there, but we could certainly take a look at it.
I think we should be able to do some kind of sensitivity analysis of where we shift some of that other residential property value into the pool by, increase one by some percentage and subtract the TV out of the other, to at least get some sense of the sensitivity is one thought I would have, but the details far better than I do, Eric. I think that might be the way to do it. We'll think about it.
Figure out.
Okay, thank you. Yeah, I know that's a big ask. Just if there was, another, 10, let's say 10% of it moved from this category to that category, how much does that change things, right?
Yeah.
Representative Fern.
Do you think our count or your count is accurate on those homes, like the 1,600 homes or properties that are cited that are over the threshold? Do you feel pretty good about the accuracy of that?
So I mean, this is you know, a fundamental question of the model, right? This is looking at tax year 2023 data and saying what would tax year 2023 have looked like under these alternate assumptions. And there's a lot of, you know, inherent assumptions that go into modeling things that way, right? So I think it's not inaccurate, but I mean, it's certainly not accurate record. I mean, it's not exactly what's going to happen. Let me put it that way. But it's the best information we have available. And additionally, I will say that as we get better information, we will incorporate that into this analysis. So like as tax year 2024 values become available, which isn't a reappraisal year, but you know, for class 4, but there are things that change in any given tax year. New homes are built and things of that nature. So we will incorporate that. And then the other piece of data that we are waiting for or will incorporate when it's available is the additional rebate amounts. Presumably, we're kind of operating under the assumption that there will likely be more properties that apply for rebates in the coming year than applied for in the initial year. And so once we have that information, we will incorporate it into this analysis. I don't know if that totally answers your question, but that's the information I have.
No, that's good. It just, when I think about it, it seems like a kind of a low number, but then we're looking at taxable value. And then, you know, it's sort of like the new industry of the state. So, you know, what's replacing pyramid lumber and replacing the aluminum plant are these 1,600 very highly valued properties that are going to help, you know,
well, and those
provide
are
equity.
primary residences as well. You know, there's also the
Right.
high value ones that aren't.
Right. Yeah, I think Representative Fern, those 1,600 homes are specifically the primary homes. So those are people that are still qualifying for the homestead exemption, but they have so much value that the amount of their value above 1.3 million means their tax bill would still increase over what it is now. Presumably, there are, you know, tens of thousands of non-primary homes that will see tax increases.
But we
And the
don't
other-
know that. We don't know that number.
Correct, because we don't know the split of rental versus second home versus vacant property, Airbnb. All that stuff is much squishier than the rebate data. So we can say for certain of the rebate properties, we know these are primary homes. This is what will happen to these homes. The other ones we're making percentage estimates. We're lumping value in together and, you know, dividing it into categories by percentages rather than being able to look at a specific property and say, this is what will happen to this property.
So Dave, they know, for example, they're mailing 21% of the taxable values of Montana to an out-of-state address. I would guess a significant portion of those numbers are going to be in the other category.
Correct. That makes sense.
And
Additional
And
thoughts, comments?
I can't emphasize enough that the participation in the rebate program numbers to give us the primary homes, the shift that we see between these 2 years will give us a pretty good idea of how much of that 100,000 we missed. If it's a small shift, we probably didn't miss many. If we get 10,000 more homes applying or 15,000 more homes applying, of that 100,000, this current model is not missing too many. If we get 75,000, then we missed a lot. We will get additional information. Eric's already said it, but I'm just trying to restate it, that we will know a lot more, and we will know a lot more about our error. We will not know terribly much more about second homes and short-term rentals. And that's just the reality. But overall, it's pretty good work. It's really impressive. I'm glad I worked with these guys from the Department of Revenue.
He has a good model. All right. Well, if you have any individual questions, please, or models you want built, please make sure you talk to these folks. And with that, I guess we'll present on the 4th. We'll see how the overall committee reacts and their thoughts. And it seems like we're moving in the right direction. So with that, unless someone's got a different, something for the greater good, I think we've kind of reached the end of beneficial talk. All right, all. Well, thank you, and we'll go ahead and call this meeting adjourned.